Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us in this week's Market Cover for January 23rd, 2025. This week, we're going to talk to you about some economic cycles and some context there, and then Andrew's going to cover the key technical support levels. So let's just jump right into the economic cycle. I think this is some important context as we go into a new year. I'll start by saying back a couple of years ago, 2022, 2023, and even into last year, there was a wide expectation that because we had been growing and expanding, that we would soon be entering into a recession. And of course, that warning kind of came and went, and we didn't actually enter one. And what this chart shows you is just actually how young in the cycle we are right now, which is just at 54 months. I will say it's a couple months old, this chart, so we can actually add one and soon to be two. But what you see here is that it is actually young when we compare it to past expansions. 2009, which set the record there, was just went on and on and on. The Energizer Bunny recovery following 2009. Interrupted by COVID, of course, but we've also had some other long ones on there. The dotted line represents the historical average, which is at 85 months. So at 54, we'd have a long way to go just to get to average. So again, we're talking about the economy here. Always important to know that the market is willing and often has a mind of its own, and it can go in different directions, but it's important to have a mind here on the economic cycle and kind of put to bed that we don't necessarily have to have a recession right around the corner. Another point that I would make is that over time, what we find is that cycles are tending to be longer. And I think there's some economic justification for that, twofold. First, the Fed certainly is often kind of the villain of the economy, easy target on its back. But over time, a reformed monetary policy has certainly worked, I would argue, to shorten certainly the down part of cycles and kind of minimize volatility in the economy. And then secondly would be inventory. Traditionally, what you would have to turn cycles would be the management of inventories. You'd have industries and retailers, they would get excited about an economy that's growing, and then they would build up inventories until you had a little bit of a slowdown, and then they kind of had to unload that. And that would be a big source of a turning point in the economy. But as technology has gotten better, inventory cycles have gotten much shorter. And you add those two things together, and many other, and the cycles actually work longer. So again, we are still in a cyclical economy. Curveballs can come out of left field, but if we're just taking a step back, we are in still an early economic cycle that could have a long way to run if it were just to match recent examples of past expansion. So that's the economic side. Again, keep in mind that is the economy. The market can and does go in different directions at different times. So Andrew, I will turn it over to you for market trends.
All right, thanks, Adam. So if you saw last week's market cover, the chart that I brought should look pretty familiar because it's an updated version of that one. So just as a refresher, or those of you that maybe didn't see last week's market cover, I shared two charts. The first one was looking at some bearish data. We started to see less stocks were holding their uptrends and were beginning to diverge from the overall S&P 500 index, which typically can result in the price of the index itself beginning to decline as more stocks start pulling it lower. And the next chart I shared was the one that I'm bringing again this week, was looking at what the index itself was doing on a weekly basis and how we've had this key level of support that held up throughout last year each time we did see a minor pullback in the index. And as we approach that level today, how was the S&P 500 going to react with it being tested once again? And I said, but what we want to use this information for is we have this thesis where we start seeing maybe one set of data that's starting to break away from the market, maybe saying that things could start to decline. And then we start looking for price confirmation and looking for the index itself to begin to reflect that type of data. And so I shared this chart saying we're testing that support and we want to see how does the market react to it. And so now that we've gotten a little bit, somewhat of an answer to that, just 1 week's worth of data, I want to provide a quick update to that to kind of show you what we're watching as well. And so as we can see, it's the similar chart as last week. That blue line, you can see with the arrows pointing to it, that was where the S&P 500 kept pulling back to last year. finding support, buyers would come in and price would go higher. Then we tested it again last week, and we saw the market respond positively. Buyers, once again, so far have stepped in, and the market's been moving higher and more positive. And we're starting to see some of that breadth data that I discussed last week, that bearishness is starting to fix itself as well. And this is a great example so far of where we have a thesis where something could happen in the market and how we rely on the data, we rely on the market itself to tell us if it's important enough right now, if the market's responding to it, if we need to be responding to it. And at this point in time, the answer so far right now is not yet. The market's still holding up strong. We're still just a couple points away from an all-time high, and the uptrend itself within the S&P 500 remains firmly intact. So this is something that we watch every single week. We go through all the data, all the charts, all the individual stocks to determine where the risk is and then begin to look for if the market begins to respond to it. And we do this week after week to evaluate what changes we need to be making to the overall exposure to the market within the models in your portfolios as well. So hopefully you found this interesting, kind of a look into how we're evaluating the market every single week and some of the charts and data that we're using to make those kind of determinations.
Very excellent. Well put, Andrew. So thank you. And thank you to all of you for giving us your time. If we can be of service in any way, please don't hesitate to reach out. You can give us a call, 800-928-4001, or you can scan the QR code there and begin the process electronically. Thanks again. Have a great weekend.